It doesn't matter whether you're 20, 30, 40, 50, 60, or 70. They were forced non-financial investment professionals to take risk.
Hey guys, welcome back to the channel. Today we have Michael Saylor giving us his prediction for the current stock and crypto markets, as well as his predictions for the financial climate with respect to inflation and the ever-increasing interest rates. We've had some pretty severe corrections recently, and the correlation between the stock market and the Fed money printer is becoming more evident, with seemingly producing of money out of thin air. Saylor also talks about the amount of global market value that has been wiped out in just the last 5 months and how the banking infrastructure is being threatened. He'll also talk about how similar the current recessionary climate is to the crash of 2008, up to and including the credit market. Make sure to stay till the end of the video to hear what Michael Saylor's prediction for the current market crash, inflation, and how this recession will affect the financial markets and what's coming next. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
I think that the economy of the world, like I would say Western civilization, but maybe I actually think the entire global economy peaked in January of 2020. I think if I think about January 1st, like New Year's of 2020, just before, we got hit with COVID, and I think about how the world worked. The concert business was raging and travel was raging and the airlines were working smoothly and the hotels were on fire and small businesses were on fire and there was entrepreneurialism everywhere and an explosion of yoga studios and specialty everything. I think we kind of hit the peak of this entire business cycle then. Everybody was able to go about their business unfettered. We had a little bit of monetary inflation in the system. And so it wasn't like things were perfect. They weren't perfect. But, compared to what came in the next 2 years, which is just unprecedented government intervention in every aspect of our lives, telling you who could come to dinner, how far away you had to stand from your kids, how many masks you need to wear, how many you need, whether or not you can go to the gym, whether you could go to the office. So many things happened that intervened with the free market, and they were all restraints of trade, creating massive inefficiency. And I think policy intervention unprecedented across every dimension of life. You got a war on carbon, a war on corporations, a war on foreigners, a war on trade, a war on, I could go on and on and on, but wars are unprecedented policy interventions by governments in our lives.
The increasing prices of goods and services, along with stagnant wages, slower business growth, and a surge in layoffs, a recession is a certainty at this point. Some believe we're in a stock market crash as we speak because of all the panic selling that's going on. Michael Saylor believes that the crypto market is one of the biggest affected by this economic downturn.
If I go back to January, and I just picked like January 1st, 2020, while we were still innocent and before it hit, and then the war on currency hit, et cetera. And then you go forward to today, and I look at what happened. Well, the money supply, the M2 money supply of the US dollar expanded, by my chart, 41%. We expanded the money supply about 41%. Now, how did all the assets behave? Well, gold is up 20% since that day. So gold captured half the money supply expansion. It didn't track the money supply. What did track the money supply? US single family homes up 45, 46%. We all know the story of home prices exploding. So single family homes slightly outpaced that money supply. Granted, the money supply is like an imperfect government metric. They give you their best estimate with a 1 or 2 month delay. So, I mean, it might be the single family homes are about at the money supply. NASDAQ, the index, 19% from that date. Up 20%, but the money supply is up 40%. The S&P index up 13% from that date. Bitcoin up 185% from that date. So and if you picked a broad commodity index, I bet, I think the commodity index up double the US home. So you would have beat the money supply slightly with desirable real estate. You would have beat it with commodities. You beat it with Bitcoin, which is like a basically synthetic digital commodity, but it's scarcity. You wouldn't beat it with gold. You wouldn't beat it with NASDAQ stocks. You wouldn't beat it with the S&P index. If we had bet 250 million on Bitcoin, or sorry, 250 million on gold, it would have been down 10%. Gold is down 10% since August 10th, 2010. So gold got a boost in the first part of the crisis, but then it kind of flagged. NASDAQ is like flat, minus 1%, 0%, went nowhere for the entire 18 months. The S&P slightly up 11%. Single family homes up 26%. The money supply up about 20%, maybe 25%, depending on how you count it. So again, single family homes tracking the money supply. Bitcoin, even as it's been thrashed right and left, up 86%. If your time horizon is less than a year, you're a trader. Even if it's less than 2 years, you're sort of a trader. And if you're a trader, you can be right or wrong about anything in that 18-month time frame. You could have said you're an idiot not to buy Amazon stock when it was whatever, and you're an idiot not to have sold it after it doubled, and you're an idiot not to have, right? You can just drive yourself crazy if you're a trader. And so that's why I don't join with the traders. I just don't know it. I think you need to have proprietary expertise of some sort. Year to date, the 2-year, has gone from 76 basis points to 310. So I think we got on a wild roller coaster from a macroeconomic point of view, starting in March. 15 days to stop the spread. You remember the 15 days to stop the spread? 2 years have gone by, 2.5 years have gone by. My office is like 10% occupied. There's no 15 days, not 15 months. Call it 4 years after that happened, we will get to a new normal, and we will never go back to the old normal. So macroeconomically, if you're looking for any good idea with a time horizon of less than 2 or 3 years, even 4 years, you're just a trader, right? And I think there's something wrong. There's a moral hazard to making 99% of the population traders, right? The real moral hazard of the government monetary policy is by pegging the interest rates to zero and by yield curve control, they've demonetized the currency, or they've eliminated the currency as a store of value for savers. And that means they've forced retirees, it doesn't matter retirees, it doesn't matter whether you're 20, 30, 40, 50, 60, or 70. They were forced non-financial investment professionals to take risk, forced them to take risk. And then the cruel joke of it all is, in addition to destroying your savings account and destroying sovereign debt as a store of value, they also have put equities on a roller coaster. So that, if we look at the roller coaster of the S&P index or the NASDAQ index, if I can't buy the bonds, I got to buy the index. And they put the indexes on a roller coaster, and they put them on the roller coaster by, I don't know if your memory's good. You might remember, a certain head of a central bank saying, we're not even thinking about raising interest rates until the year 2024. What, by the way, is it 2024 yet? I mean, the irony is you're sitting there watching interest rates at zero, and they're saying, well, it's 4 years. Okay, well, 2 years later, and we're getting a 75 basis point jump.
Even though the market may be operating on fear right now, the coming months will be a clear indicator of what we can expect from the stock, crypto, and capital markets up until the end of the year. The average consumer will be the one affected the most by this recessionary climate, and will have to keep an eye on the financial corrections happening in the credit and housing markets. The interest rates on loans are rapidly increasing, and we may actually be seeing a bubble there as well. What do you think about the market conditions right now, and how do you think the average consumer will be affected? Comment down below. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.